Most investors believe that having a great idea is all they need to make money in the markets. They research carefully, they find the right company, they study the numbers, talk to experts, and build a strong case for why a particular stock should rise. And then, with full confidence, they place their trade. But here is the truth that almost nobody in finance discusses openly. Having a great idea is not enough, not even close. The world is full of brilliant investors with excellent ideas who still end up losing money. Not because their ideas were wrong, not because the company they believed in failed, but because of what they did or failed to do after the trade was placed, because of how they behaved when things went up, because of how they responded when things went against them, because of execution. Lee Freeman-Shor spent years giving real capital to some of the finest investment minds on the planet. He tracked every single trade. He studied every decision. He recorded every outcome. And what he found was remarkable. The difference between those who built genuine wealth and those who fell short was not the quality of their ideas. It was the quality of their execution. This is the story of that discovery, and it will change the way you think about investing forever. Let's begin. The story behind this body of work starts with an experiment unlike anything else in the world of professional investment management. Lee Freeman-Shor held a position of extraordinary access and responsibility. He was tasked with identifying some of the finest investment talent in the world and allocating them real capital to manage. These were not ordinary investors, plucking stock names from a newspaper or following tips from friends. These were deeply experienced, highly respected professional fund managers who had spent decades studying businesses, markets, and economies. They had track records. They had frameworks. They had the kind of intellectual horsepower that most participants in financial markets can only dream of possessing. Over the course of roughly a decade, Freeman-Shor tracked the performance of these elite managers with a level of detail that is genuinely rare in financial research. He did not simply observe their overall returns at the end of each year. Any observer with access to a spreadsheet can do that. He went much deeper. He examined individual trades from the moment they were opened. He tracked what happened in the days, weeks, and months that followed each initial investment decision. He studied how these managers responded to adversity, to unexpected bad news, to stocks that fell sharply against them after they had bought. He studied how they responded to success, to stocks that rose strongly and confirmed their original thinking. He tracked every addition to a position, every reduction, every exit, every moment of decision. The picture that emerged from all of this meticulous observation was, in the very best sense, surprising. Not because the managers were worse than expected. Many of them were genuinely brilliant analysts with sharp minds and rigorous processes. The surprise came from where the real differences in performance originated. Freeman-Shor had expected that the managers who produced the best returns would simply be the ones with the most accurate ideas, the ones whose research was deepest and whose predictions about company performance were most reliably correct. This is, after all, what most financial education would suggest. Find better ideas, make better predictions. The returns will follow automatically. But the data simply did not support this expectation. What the data showed, clearly and repeatedly, was that the managers who built the most wealth for their investors were not necessarily the ones with the most accurate ideas. Many of the underperforming managers had ideas that were just as good, sometimes better, than the ideas of the outperformers. The companies they identified were often the right ones. The businesses they analyzed often performed broadly as they had predicted. The investment theses they had constructed were frequently well-reasoned and fundamentally sound. And yet, the financial outcomes produced by these good ideas were, in many cases, deeply disappointing. The reason, as it turned out, had almost nothing to do with the quality of the ideas themselves. It had everything to do with what happened after the ideas were translated into actual positions in the market. It had everything to do with the behavior of the investor once the trade was open, once the position was on the books, once the emotional and financial stakes were real. It had everything to do with execution. This is the central and revolutionary insight of this entire body of work. In investing, execution is not a secondary consideration. It is not the boring, administrative, slightly mechanical process that follows the exciting, creative work of finding and analyzing ideas. Execution is, in fact, the primary determinant of whether ideas translate into actual returns. And the failure to execute well, even when the underlying ideas are excellent, is the single most common reason why intelligent, well-researched investors consistently underperform their own potential. Think about what this means for a moment. It means that right now, somewhere in the world, there are investors who are holding perfectly good investment ideas, companies that really will perform well over the coming years, situations that really will develop as the investor originally predicted. And those investors are still losing money. Not because they were wrong about the companies, not because the market is rigged, but because of what they are doing and what they are failing to do in the ongoing management of those positions. Because of execution errors that are predictable, documentable, and, crucially, correctable. Freeman-Shor translated his observations into a framework of 5 distinct behavioral types. These 5 types represent patterns that emerged with striking consistency across the many different professional managers he observed. Regardless of their individual personalities, their specific investment philosophies, the sectors they focused on, or the specific approaches they used to analyze opportunities, when it came to execution, they clustered into 5 clear behavioral archetypes. 3 of these 5 types are consistently associated with underperformance, with missed opportunities, and with capital destruction over time. The other 2 are consistently associated with superior long-term performance, with the ability to actually capture the returns that good investment ideas should theoretically generate. The 3 losing types are called the rabbits, the losing assassins, and the raiders. Each of these types has a distinctly different flavor of failure, a different set of emotional drivers and behavioral patterns. But they all share one critical feature. They all represent execution behaviors that systematically and predictably destroy value over time, regardless of how good the underlying investment ideas might be. The 2 winning types are the hunters and the connoisseurs. They also have different approaches and different behavioral patterns, but they share a fundamental commitment to disciplined, rational, pre-planned execution that allows their good ideas to generate the returns they deserve, while keeping the damage from their bad ideas strictly limited and manageable. We are going to explore each of these 5 types in considerable depth. We are going to understand the psychological forces that drive each behavior. We are going to look at the specific situations where each type appears most clearly and most destructively, or most beneficially. And we are going to identify the specific steps that any investor can take to move away from the losing patterns and toward the winning ones. This is not abstract theory. This is a practical guide to the most important skill in investing. Let us start with the losing types. And let us begin with the most common, the most psychologically understandable, and in many ways, the most costly of them all. The rabbit is an investor who, when a trade goes against them, does nothing. They freeze. Like the animal caught in the headlights of an approaching vehicle, the rabbit investor sees the danger approaching, feels the fear, senses the need to act, and yet cannot bring themselves to move. A stock they own begins to fall. It falls further. It falls more still. Days pass, then weeks, then months. And through all of this, the rabbit watches. They monitor the price. They check the latest company announcements. They perhaps re-examine their original analysis, searching for reassurance, but they take no decisive action. They do not sell the position and limit the loss. They do not add to the position based on updated conviction. They simply hold, and they hope. Hope is not a strategy in the financial markets. It has never been a strategy, and it will never become one. Markets do not reward hope. Markets reward disciplined, informed, timely action. And the specific type of disciplined action that a falling position demands is either a clean, decisive exit that limits the loss to a manageable level, or a carefully analyzed, conviction-based addition to the position that reflects a genuine belief that the stock is now even more attractive at a lower price. The rabbit does neither of these things. They hold and they hope, and in doing so, they allow what might have been a manageable small loss to grow into a devastating large one. Understanding why the rabbit behaves this way requires understanding several overlapping psychological mechanisms that are deeply embedded in human cognition, present in all of us regardless of our level of experience or sophistication. The first and most powerful of these is loss aversion. This concept, which has been studied and documented extensively by behavioral economists, refers to the well-established finding that the psychological pain of losing a given amount of money is felt with approximately twice the intensity of the pleasure felt from gaining the same amount. This is not a rational quirk of individual personality. It is a consistent feature of how human beings experience financial gains and losses, documented across cultures, across age groups, across levels of financial sophistication. The practical effect of loss aversion on investor behavior is profound and consistently negative. When a stock we own falls in value, the emotional pain we feel is disproportionately intense relative to the actual financial loss. Our brains register a financial loss as something closer to a genuine physical threat than to a calm, numerical calculation. And paradoxically, this intense emotional pain pushes us toward inaction rather than toward the decisive action the situation requires. We cannot bring ourselves to sell because selling would make the loss real. It would crystallize the pain. It would remove the possibility of recovery. And so we hold. We endure the ongoing discomfort of a falling position rather than accept the sharper, more definitive discomfort of a realized loss. The rabbit is, in the most literal sense, a prisoner of loss aversion. A second psychological mechanism that compounds the rabbit's problem is called the endowment effect. Research in behavioral economics has consistently shown that once we own something, whether a physical object, a business, or a financial asset, we tend to value it more highly than we would if we did not own it. The mere fact of ownership creates an emotional attachment that inflates our subjective sense of the thing's worth. In the context of investing, this means that the moment you buy a stock, you have already begun to value it more than the price at which you can currently sell it. It has become part of your story, part of your self-image as an investor who makes smart decisions. Selling it, particularly at a loss, feels like abandoning something that is rightfully yours, and so the rabbit holds on, overvaluing their position relative to the actual market price, unable to let go. The third mechanism is confirmation bias. Once we have made an investment decision, our minds begin to filter incoming information in a way that strongly favors evidence consistent with our decision and systematically downplays evidence that contradicts it. When the stock falls, the rabbit searches for reasons why the fall is temporary. They find positive news about the company and give it disproportionate weight in their mental model. They dismiss or rationalize away negative news that might suggest the original thesis is flawed. This is not deliberate dishonesty. It is not even conscious in most cases. It is simply the way human cognition naturally operates. And in the context of investing, it is extraordinarily dangerous because it means our thinking is biased in exactly the wrong direction at exactly the moment when we most need clear, objective analysis. Loss aversion, the endowment effect, and confirmation bias all push in the same direction. They all push the rabbit toward holding a losing position longer than any rational analysis would justify. And they all do this most powerfully at precisely the moments when the decision is most critical, when the position has fallen sharply and immediate action is most needed. Freeman-Shor's research revealed something particularly sobering about rabbit behavior. It appeared not only among inexperienced or unsophisticated investors, as one might expect, but repeatedly and consistently among the highly experienced, highly intelligent professional managers he observed. These were people who had studied markets for decades, who had trained under distinguished mentors, who had seen multiple market cycles and understood, at an intellectual level, all the arguments against holding a losing position without a plan. And yet, the rabbit instinct was powerful enough, time after time, to override their expertise, their training, and their conscious rationality. This tells us something very important. The forces driving rabbit behavior cannot be defeated simply through experience or knowledge. They can only be defeated through a specific kind of system, a set of pre-committed rules that take the decision out of the hands of the emotional mind at precisely the moment when the emotional mind is least trustworthy. The solution to rabbit behavior is the pre-committed exit plan. Before opening any position, the investor must decide, in advance and in writing, exactly what they will do if the stock falls by a specified amount. They must set a specific price level at which they will exit without debate, without rationalization, without waiting another day to see if recovery is coming. This pre-committed exit level acts as a circuit breaker that interrupts the emotional feedback loop driving rabbit behavior. It says, in effect, that this specific decision has already been made by a calmer, more rational version of yourself before the emotional pressure was engaged, and it demands that you follow through on it. The act of pre-committing an exit level also forces you to confront, before you buy anything, a question that most investors never ask honestly. How wrong am I willing to be on this trade? If you are not comfortable owning this stock, if it falls by 20%, then you need to have that decision made before you buy it, not after it has already fallen 20%. Because after it has fallen, the emotional pressure against selling is at its maximum. The only moment when you can make that decision rationally is before the position is opened, when your emotions are not yet engaged, and your thinking is not yet distorted by the pain of an existing loss. Now, let us turn to the second losing type, which Freeman-Shor calls the losing assassin. This character is more nuanced than the rabbit, and understanding them requires some care, because in one respect, the assassin does something right. The assassin cuts losses. When a position goes against them, they act. They exit the trade. They accept the pain. They move on. In isolation, this is exactly the behavior that every experienced investor would endorse. The ability to cut a losing trade cleanly and without excessive hesitation is, as we have discussed, one of the most valuable execution skills an investor can develop. The problem with the losing assassin lies entirely in what happens on the other side of the equation. The losing assassin, having built the habit and the psychological comfort of acting quickly to close positions, applies the same swift decisiveness to their profitable trades as well. When a stock rises in their portfolio, the assassin feels the same urge to act, to close the position and secure the gain, to convert the paper profit into a real, tangible, definitive win. And all too often, they follow this urge. They take the profit. They celebrate the win. They feel the clean, satisfying finality of a completed trade that made money. And then they watch the stock continue to rise, sometimes for many years, without them. The mathematical effect of this behavior, applied consistently over time, is devastating. If you cut your losing trades and also cut your winning trades with equal decisiveness, keeping your average gain roughly similar in size to your average loss, then your profitable trades will never be large enough to meaningfully grow your wealth. Real, substantial wealth from investing comes from asymmetry, from having losses that are kept small and manageable while allowing wins to grow as large as the opportunity will allow. When the losing assassin cuts both winners and losers with similar decisiveness, they destroy this asymmetry entirely. Their portfolio becomes a collection of modest, frequent results, none of which are large enough to make a meaningful difference, and none of which can compensate for the compounding effect of even modest losses over time. There is a specific psychological mechanism that drives the losing assassin's premature profit-taking, and it is closely related to loss aversion. Even when we are sitting on a winning position, we experience what might be called gain anxiety, a fear of losing the profit we have accumulated. We are aware that the profit is not yet real, that it exists only on paper, and that the market could take it away from us at any moment. This awareness creates discomfort, and the relief from that discomfort that comes with selling, with turning the paper profit into a real, secured gain, is intensely appealing. The assassin, trained to act decisively to relieve discomfort, takes the profit and experiences that relief. And in doing so, they systematically sacrifice the larger returns that patience would have generated. It is essential to understand that cutting losses quickly and letting winners run are not simply two independent pieces of advice. They are two halves of a single coherent strategy, and neither half works without the other. You can cut losses quickly all you like, but if your winning trades are also cut quickly, the strategy produces mediocre results at best. The whole point of cutting losses quickly is that it frees you to hold your winning positions aggressively, because you know that your downside on any individual position is capped. If your losing positions cannot hurt you badly, you can afford to let your winning positions grow very large. But if you are cutting winners as quickly as losers, the strategy is internally incoherent, and the results will show it. The winning version of assassin behavior, which Freeman-Shor also identifies in his research, combines the same decisive loss cutting with a completely different approach to winners. The winning assassin cuts losses fast, without sentiment, and without rationalization. But they treat their winning positions with patience and respect, holding them until there is a specific, analytical reason to believe the opportunity is genuinely over. Not until the position feels large and uncomfortable. Not until a market commentator raises a concern. Not until the stock has gone up a lot and the emotional pull to take the money becomes strong. Until the analysis says it is time to go. This single difference in behavior, applied consistently over years, produces dramatically different long-term results. Now, let us look at the third losing type, the raider. The raider is, in many ways, the most immediately appealing of the losing types, because the raider always appears to be winning. They have a high proportion of profitable trades in their history. They are constantly booking gains, locking in returns, celebrating successful investments. Their trading record looks, on the surface, impressively positive. And this creates a genuine and dangerous illusion, an illusion that a high frequency of winning trades equals good investment performance. This illusion is one of the most common and most costly mistakes that investors make, at every level of experience and sophistication. In almost every other domain of human achievement, success is correctly measured by how often you succeed. A student who gets 9 out of 10 answers right is performing better than one who gets 5 out of 10 right. A surgeon whose operations succeed 90% of the time is objectively better than one whose operations succeed 50% of the time. Frequency of success is the right metric in these domains, and it is natural to import this intuition into investing. But investing is fundamentally different from these other domains. In investing, what determines your long-term outcome is not how often you win. It is the combination of how often you win, how much you make when you win, and how much you lose when you lose. A trader who wins on 70 out of every 100 trades, but whose average winning trade returns only 5%, while their average losing trade costs 15%, is destroying capital consistently despite their impressive win rate. Their frequent small wins are being overwhelmed by the disproportionate size of their losses. Conversely, a trader who wins on only 40 out of every 100 trades, but whose average winning trade returns 25%, while their average losing trade costs only 5%, is building wealth steadily despite their relatively poor win rate. Their disciplined loss cutting, combined with patient holding of winners, creates a powerful asymmetry that works in their favor over time. The raider falls squarely into the first of these patterns. They generate frequent small wins, and they take those wins gratefully and promptly. But because they apply the same hair trigger to their selling decisions on both sides, their occasional losses, lacking the same decisive attention, can grow disproportionately large. And even when their losses are kept reasonable, the compounding arithmetic works against them, because no individual winning trade ever grows large enough to compensate for the cumulative effect of all the small gains that were taken too early. The deeper problem with raider behavior, and the one that perhaps best illustrates its true cost, is that raiders never experience the transformational power of a great investment held for a long time. The most extraordinary wealth created in the history of financial markets has come from investors who identified exceptional businesses and then held for years, sometimes decades, while those businesses compounded their earnings and their value at remarkable rates. These holding periods were not always comfortable. The stocks fell and recovered and fell again. There were periods of doubt and frustration. There were moments when every voice in the market said the easy gains were already made. But the patient holders stayed. And eventually, the compounding did what compounding always does when given enough time. It produced returns that were genuinely life-changing. The raider will never experience this. Every time one of their positions rises to the point where the quick profit instinct is triggered, they exit. Every time the stock shows a meaningful gain, they lock it in and move on. They skim the surface of every investment opportunity, capturing a thin layer of return from each, and then they miss everything below the surface, the deep, sustained compounding that creates the most extraordinary returns. The raider feels competent because they are always booking wins. But they are, in a very literal sense, winning individual battles while losing the financial war. The antidote to raider behavior is a deliberate, pre-committed commitment to evaluating winning positions based on analysis rather than on the size of the current gain. The decision to exit a winning position should never be driven by the fact that it has gone up a certain amount. It should be driven by a specific, analytical assessment of whether the original investment thesis is still intact and whether the underlying business still offers attractive future returns. If the analysis says yes, if the business is still compounding beautifully, and the original reasons for owning it are still valid, then the raider impulse to take the profit should be consciously identified and consciously rejected. This requires a specific type of discipline that goes against the grain of natural human psychology. Sitting on a large paper gain and choosing not to lock it in feels risky. It requires tolerating uncertainty, accepting the possibility that the gain could reduce before it grows further. But this is exactly the uncertainty that great investing demands. The investors who built the most wealth did not do so by avoiding uncertainty. They did so by identifying situations where the uncertainty was outweighed by the probability of an exceptional long-term outcome, and then sitting with that uncertainty patiently for as long as it took for the outcome to materialize. We have now met all three losing types: the rabbit who freezes in the face of adversity, trapped by loss aversion, the endowment effect, and confirmation bias, unable to sell a falling position until the loss has grown from manageable to devastating. The losing assassin who cuts both winners and losers with equal decisiveness, generating a symmetrical but ultimately value-destroying pattern that eliminates the asymmetry which great investing requires. And the raider who takes quick profits compulsively, enjoying the frequent satisfaction of small wins while systematically missing the transformative, compounding returns that patience makes possible. Before moving to the winning types, let us acknowledge something important and honest. None of these three patterns of failure are the result of stupidity or poor character. They are the result of perfectly normal, deeply human psychological tendencies meeting an environment, the financial markets, where those tendencies consistently produce bad outcomes. Loss aversion, the endowment effect, confirmation bias, gain anxiety, the desire for quick confirmation of being right. These are features of human cognition that served our ancestors well across hundreds of thousands of years of evolution. They are not character flaws. They are part of who we are as a species. The challenge is that they are consistently and predictably counterproductive in an investment context. This is also why simply knowing about these biases is not sufficient to overcome them. Many investors are aware of loss aversion. Many have heard the advice to let winners run. Many understand intellectually that taking quick profits is suboptimal over the long term. And yet, they continue to exhibit exactly the behaviors that these biases predict. The knowledge helps at the margins. But what actually changes behavior is a system, a set of pre-committed rules decided in advance when the mind is calm and the analysis is clear that govern behavior at the specific moments when emotional pressure is highest and rational decision-making is most compromised. Let us now cross the boundary into the territory of the winning types. The investors whose behavior, though often counterintuitive and emotionally uncomfortable, generates results that separate them clearly and consistently from the crowd. The hunter is the first winning type, and they are immediately surprising. Not because their strategy is exotic or technically complex, but because the core of what they do, the central behavior that defines them, sounds at first hearing like exactly what you have been told never to do. The hunter, when a stock they own begins to fall against them, buys more of it. They add additional capital to a losing position. They invest more money in a stock that is moving in the wrong direction. This sounds, and certainly feels, dangerous. And in the wrong hands, applied without discipline or analysis, it is dangerous. But done in the specific, structured, conviction-based way that defines the true hunter, it is one of the most powerful execution strategies available to any investor. The first and most critical distinction to understand about the hunter is the difference between disciplined conviction-based adding and reckless averaging down. These two behaviors look the same from the outside. Both involve buying more of a stock that has fallen, but they are fundamentally different in their logic, their discipline, and their likely outcomes. Reckless averaging down happens when an investor buys more of a falling stock simply because it is cheaper than it was, without any fresh analysis, without any updated assessment of whether the original investment thesis still holds, and without any clear limit on how much they are willing to commit in total. This version of the behavior is genuinely dangerous, and it has destroyed many portfolios. But this is not what the hunter does. The hunter's approach to adding is governed by three specific conditions that must all be met before any additional capital is committed. First, and most importantly, the original investment thesis must still be intact. The hunter cannot merely feel that the stock should recover. They must be able to look at the underlying business today, with all the information available to them right now, and conclude clearly and specifically that the reasons they originally bought the stock are still valid. The question is not, is this stock cheaper than before? The question is this business still as attractive an investment as I originally believed? If the honest answer to that second question is yes, then a lower stock price simply represents a better value for the same attractive opportunity. Second, the hunter must have actively updated their analysis to incorporate whatever new information or changed circumstances have caused the stock to fall. This is a genuine analytical exercise, not a rationalization exercise. The hunter approaches their existing position with the same objectivity they would bring to evaluating a new idea they had never owned before. They ask, with genuine openness, whether the fall in the stock price is telling them something important that they missed in their original analysis. Is there a change in the competitive landscape? Is there evidence that management is less capable than originally believed? Is there a shift in the regulatory environment or the broader market for the company's products? If the honest, objective answer to any of these questions suggests that the original thesis was flawed or is now broken, the hunter does not add. They exit cleanly and move on. But if the updated analysis confirms the original view, and if the lower price makes the opportunity even more attractive, then adding becomes not merely permissible, but the optimal response. Third, and absolutely non-negotiably, the hunter must have established a predetermined exit level before any additional capital is committed. This exit level is the specific price below which the hunter will exit the entire position, regardless of how much capital has been committed across all the stages of adding, regardless of the emotional pain of executing a full exit at a loss, and regardless of the strength of their conviction that the stock will eventually recover. The predetermined exit level is the mechanism that puts a strict limit on the total potential loss from the position. It is the safety net that makes the hunter's strategy tenable rather than reckless. Understanding why this exit level is so critical requires thinking about the emotional reality of holding a losing position that you have added to multiple times. When you have invested in a position at several price levels, each one lower than the last, you have a large total commitment at stake. The emotional weight of this large commitment is enormous. Every dollar you have put into the position argues for staying in just a little longer. Every piece of analysis that originally attracted you to the investment, still valid enough to have justified the additions, now seems to argue for more patience. And the natural human tendency to avoid confirming a large, definitive loss, the loss aversion that we have already discussed at length, is more powerful than ever when the position is large. All of these forces converge to make exiting very difficult, and the predetermined exit level is the specific, concrete mechanism that overrides all of them. It says, this decision was made before any of this emotional pressure existed. It was made by a clearer, calmer version of yourself. Follow it. When the predetermined exit level is reached, the hunter exits. They exit the entire position. They take the full loss. They do not revise the exit level downward to give the stock just a little more room. They do not decide to wait for the next earnings report before deciding. They exit. This is a moment of genuine discipline, perhaps the most demanding moment in the entire hunter's process. But it is also the moment that defines the hunter as a winning type rather than a reckless one. By following through on the pre-committed exit, the hunter demonstrates that the system takes precedence over the emotion. And it is this demonstration, applied consistently over many trades and many years, that is the foundation of the hunter's long-term success. The mathematical logic of the hunter's approach, when all three conditions are met and the exit discipline is maintained, is genuinely compelling. By purchasing additional shares at prices lower than the original entry, the hunter reduces their average cost per share. This means that when the stock eventually recovers, as fundamentally sound businesses at attractive valuations generally do over time, the hunter generates a larger percentage return on the full, larger position than they would have generated by simply holding the original position without adding. The hunter captures more of the recovery. They have, in effect, turned an adverse situation into an enhanced opportunity, not through wishful thinking, but through disciplined analysis and structured action. Freeman-Shor's research identified a specific structural feature of how the best hunters in his study tended to build their positions that is worth understanding in detail. They consistently entered their initial positions at a size that was deliberately smaller than their eventual intended maximum commitment. This initial smaller size was not an expression of low conviction. It was a strategic choice, made in advance, that preserved both the financial capacity and the psychological flexibility to add at lower prices if the opportunity arose. By entering at a modest initial size, the hunter created a structured sequence of potential additions. If the stock falls to a specific lower level and the analysis still holds, they add a defined second tranche. If it falls further still and the analysis continues to hold, they add a third tranche. Each addition is pre-planned in terms of both the price trigger and the amount. The total committed capital across all tranches, assuming all are activated, equals the hunter's maximum allowable position size for that investment. This maximum is determined before the first share is ever purchased and is not subject to revision based on how the trade develops. This structured approach to position building removes emotion almost entirely from the decision of whether to add. At the preset price level, you add the preset amount. There is no agonizing decision to be made in the moment. No battle between fear and conviction. No need to assess your current emotional state and decide whether you feel brave enough to buy more. The decision has already been made. You simply execute it. And this removal of emotional friction from the decision point is precisely what allows the hunter to act boldly and intelligently in situations where most investors would freeze or flee. Now, let us turn to the connoisseur, the second winning type, and the one who perhaps represents the most complete and refined expression of investment mastery. If the hunter's defining skill is the ability to manage adversity with courage and structured discipline, the connoisseur's defining skill is the ability to manage success with patience and wisdom. And of these two skills, managing success well is perhaps the rarer and more valuable. Because while most investors understand, at least intellectually, that they should cut losses quickly, very few truly understand how long they should hold a winning position, or how much of the return from a great investment is available only to those who hold for the full duration of the opportunity. The connoisseur, when a trade is working beautifully, when a stock is rising strongly, and the original thesis is being confirmed in real time, does something that most investors find extraordinarily difficult. They hold. Not out of passivity, not out of forgetting the position exists, not out of laziness. They hold out of deliberate, active, regularly renewed conviction. They hold because they understand, at a deep and mathematical level, that the most significant portion of the total return from a great investment comes not from the early stages of the move, but from the later stages, the stages that demand patience, discipline, and the ability to sit with a large, fluctuating winning position through all the discomfort and uncertainty that entails. To understand why the connoisseur's approach generates superior returns, you need to understand something fundamental about how exceptional businesses grow and create value over time. The best companies in the world do not grow linearly. They compound. They reinvest their earnings into capabilities, products, and market positions that generate more earnings, which are in turn reinvested to generate more growth. Over extended periods of time, this compounding process produces returns that are genuinely extraordinary. The mathematics of compounding are such that the longer it operates without interruption, the more powerful its effects become. A business compounding its value at 15% annually will deliver remarkable returns over 5 years, transformative returns over 10 years, and almost incomprehensible returns over 20 years. But only to investors who hold throughout the compounding period. Every time you sell a compounding business and then try to buy back in at a lower price, you are interrupting the compounding process. You are taking capital off the table, paying taxes and transaction costs, and then waiting, sometimes for a long time, to redeploy that capital. And in the meanwhile, the business continues to compound without you. The investor who identified the business early and simply held for 20 years ends up with a dramatically larger position than the investor who traded in and out of the same stock, even if the trader had better short-term timing. The compounding of a great business is, over long enough time periods, almost impossible to beat through active trading. The connoisseur has internalized this mathematical reality in a way that governs their actual behavior, not just their intellectual understanding. They know that their most valuable positions are the ones that are working. They protect these positions fiercely, not from the market, which will fluctuate as markets always do, but from their own emotional impulses and from the endless noise of financial commentary that is always generating reasons to be cautious. They protect them from the raider impulse that says take the money and be safe. They protect them from the misguided instinct to trim a position simply because it has grown large relative to the rest of the portfolio. They protect them from the anxiety that comes with watching a large paper gain fluctuate, sometimes substantially, from day to day and week to week. The connoisseur is not immune to this discomfort. They feel it. Every investor who holds a large winning position through a period of significant decline feels the pull of the impulse to sell. Every investor watching a stock they own fall 20% from its recent high experiences the anxiety of potentially losing a significant portion of accumulated gains. The connoisseur does not suppress these feelings. They acknowledge them. And then they do something very specific with them. They use the discomfort as a trigger to conduct a fresh analytical review of the position. They ask, with genuine rigor, whether any of the recent price action or recent news represents a genuine change in the investment thesis. They evaluate the current state of the business against the criteria that originally made it an attractive investment. And if the answer to that evaluation is that nothing fundamental has changed, that the business is still compounding, and the original reasons for ownership are still intact, they hold. Not because holding is comfortable, but because the analysis says to hold. What would make the connoisseur sell? The bar is high, deliberately so. It takes a genuine, analysis-supported conclusion that the investment thesis is no longer valid. A material deterioration in the competitive position of the business. A management change or strategic shift that undermines confidence in the company's long-term direction. A valuation that is genuinely stretched to a level that makes the expected future return unattractive relative to the risk. These are legitimate, analytical reasons to exit. A stock price that has fallen 20% from its high, a period of underperformance relative to a market index, a consensus among commentators that the stock has run too far. These are not legitimate reasons. These are noise. And the connoisseur, perhaps more than any other investor type, has developed the ability to distinguish signal from noise with exceptional clarity. There is a particularly important aspect of the connoisseur's approach that deserves careful attention, and it concerns the question of position concentration. As a winning stock rises strongly within a portfolio, it naturally grows to represent a larger and larger proportion of the total portfolio. If you begin with 10 positions of equal size and one of them doubles while the others stay flat, that position now represents roughly twice as large a share of your total portfolio as it did originally. This growing concentration is uncomfortable for many investors. It triggers anxiety about being too exposed to a single stock. It triggers a desire to rebalance, to trim the winner back to a more manageable size relative to the rest of the portfolio. The connoisseur resists this desire with great discipline. They understand that a winning position that has grown large within the portfolio is, in most cases, their best idea. It is the investment that the market has confirmed, through sustained price appreciation, is developing exactly as hoped. Reducing it, simply because of its size, is at its core a form of the raider impulse dressed up in the language of risk management. And the connoisseur does not allow their language to fool them. They are rigorous about the distinction between genuine risk management, which is reducing a position because the analysis says the investment is becoming less attractive, and emotional risk management, which is reducing a position because a large, fluctuating paper gain feels uncomfortable. The former is wise. The latter is raider behavior. Of course, there are limits to this principle, and the connoisseur recognizes them. If a single position has grown to represent a genuinely overwhelming proportion of a total portfolio, perhaps the great majority of total assets, some degree of reduction may be warranted on pure risk grounds, because the failure of a single investment can have catastrophic consequences if that investment represents too large a portion of total wealth. But the threshold at which the connoisseur would consider reduction is far higher than the threshold that most investors would set. They are comfortable with significant concentration in their best ideas because they understand that this concentration, uncomfortable as it feels, is the primary source of the extraordinary returns that distinguish the very best investors from everyone else. Let us now step back from the 5 individual types and look at the broader principles that unite the hunter and the connoisseur, and separate them from the 3 losing types. These principles, taken together, form a philosophy of execution that is as simple to understand as it is demanding to practice. The most fundamental of these principles is pre-commitment. Both the hunter and the connoisseur operate from a foundation of pre-committed rules that govern their key decisions before those decisions need to be made under emotional pressure. Their exit levels are set before the position is opened. Their criteria for adding are defined before the stock has the opportunity to fall. Their criteria for holding a winner are articulated before the gain becomes large enough to trigger the raider impulse. All of these decisions are made when the investor's emotional state is calm, their analysis is clear, and the specific psychological distortions we have been discussing are not yet in play. And having been made in advance, these decisions are then followed consistently, even and especially when following them is emotionally difficult. Pre-commitment works because of a well-understood psychological mechanism. When we articulate a decision clearly and write it down, we create a form of accountability that is far more powerful than a vague intention. A written exit level that says, "I will sell this position if it falls to a specific price," is much harder to rationalize your way around when that price is actually reached than a general mental note to be disciplined. The written plan can be referred back to. It can be evaluated against your actual behavior. It stands as a concrete, specific record of what you decided when you were thinking clearly, available to you at precisely the moments when your thinking is most likely to be distorted. The second principle, shared by the winning types, is the primacy of analysis over emotion. This does not mean that winning investors are emotionless. As we have noted repeatedly, the emotional experience of investing is inescapable and universal. The fear of loss, the excitement of a winning position, the frustration of being wrong, these feelings are part of the experience for every investor at every level of skill. What the winning types do differently is not eliminate these feelings, but build systems that prevent them from determining outcomes. The hunter feels fear when adding to a losing position, but the pre-committed plan takes the decision out of the emotional mind's hands. The connoisseur feels gain anxiety when a large winning position falls temporarily, but the pre-committed criteria for selling, not met in this situation, prevent the anxiety from triggering a premature exit. The third, and perhaps most mathematically important principle, is asymmetry. Winning investors consistently create and maintain a significant asymmetry between the average size of their gains and the average size of their losses. Losses are kept small through decisive, pre-committed exits. Gains are allowed to grow large through patient, conviction-based holding. This asymmetry means that even when the winning investor is wrong on their investment ideas, more often than they are right, the overall portfolio still grows. Because the wins, when they come, are large enough to more than compensate for the string of smaller losses. This asymmetry is not a lucky accident. It is the deliberate, consistent result of excellent execution applied over time. The role of position sizing in all of this is more important than most investors realize. Position sizing is not simply a secondary consideration that happens after you have decided what to buy. It is a primary tool for managing both the risk and the execution quality of your portfolio. The specific way you size your positions determines how much room you have to add at lower prices if you want to behave as a hunter. It determines how large any individual position can grow before it represents a concentration that requires management. And it determines how much damage any individual losing trade can do to your total portfolio. Most investors think about position sizing in terms of conviction. They put more money into ideas they are more confident about and less into ideas they are less confident about. This is not wrong as a principle, but it is incomplete. What Freeman-Shor's research adds to this intuition is the importance of thinking about position sizing in terms of execution optionality. Specifically, You need to think about how the size of your initial position affects your ability to manage the position well over its lifetime. If you enter a position at too large an initial size, you lose the ability to add at lower prices in a hunter-like way because you are already at or near your maximum comfortable commitment. When the stock falls and the analysis says the thesis is still intact, you cannot add because you have no room left. You are forced into rabbit behavior not by psychology, but by mathematics, by having already used up all the capital you are willing to commit. Conversely, if you enter a position at a size so small that you are unlikely to pay close, ongoing attention to it, you may fail to manage the winning version of the position well, trimming or exiting too casually when you should be holding with connoisseur-like discipline. The optimal initial position size leaves room in both directions. It allows you to add if the stock falls and the analysis supports it, and it is large enough that you will pay genuine, serious, ongoing attention to the position as it develops, giving you the motivation to conduct the regular analytical reviews that good execution requires. Finding this balance, which will be different for every investor and every investment, is one of the most important practical skills in position management. Time horizon is another dimension of execution that most investors handle poorly. Every investment thesis operates over a specific time frame. Some theses are short-term, based on an upcoming catalyst, an earnings announcement, a regulatory decision, a product launch. These theses might play out over weeks or a few months. Other theses are long-term, based on a multi-year growth trajectory, a gradual shift in competitive positioning, a secular trend that will take many years to fully develop. These theses might require years of patient holding before the full return is realized. The critical execution error that many investors make is evaluating positions against a time frame that is inconsistent with the underlying thesis. If you buy a stock based on a 3-year thesis about a company's long-term growth trajectory, and you then evaluate that position on the basis of what happens in the next 3 months, you are almost certainly going to make poor decisions. Short-term price movements will look like evidence about the validity of a long-term thesis when they are, in most cases, simply noise. A stock that falls 20% in the first 3 months of your holding period is not necessarily evidence that your 3-year thesis is wrong. It might simply be a temporary market reaction to a short-term event that has nothing to do with the long-term story you originally identified. Freeman-Shor is very clear about the need to match your behavioral responses to the time frame of your investment thesis. If your thesis is a long-term one, short-term price movements should carry very little weight in your ongoing decision-making about the position. The relevant question is not, is the stock up or down since I bought it? The relevant question is the business developing in the way I originally predicted? Are the long-term factors I identified when I made the investment still in place and still pointing in the direction I anticipated? If the answer to these questions is yes, then short-term price weakness is not a reason to reconsider the position. It may, in fact, be an opportunity, either to add like a hunter or to hold like a connoisseur, depending on the specifics of the situation. This principle has a very practical implication for how you write your pre-trade plan. Your plan should include, explicitly, your expected holding period for the investment. Not a precise date, but a general time frame within which you expect the thesis to play out. This time frame then becomes part of the filter through which you evaluate subsequent price movements and news events. Events that are relevant to the thesis within your specified time frame deserve attention and analysis. Events that are short-term in nature and irrelevant to the long-term thesis deserve to be filed under noise and set aside. Making this distinction consistently, resisting the constant pull of short-term market commentary to evaluate long-term investments on short-term grounds, is a major part of what it means to execute with connoisseur-level discipline. Let us also talk about what happens after a bad trade, because this is another area where execution quality matters enormously and where many investors compound their initial mistakes with further ones. Every investor, without exception, has periods of poor performance. Every portfolio will contain positions that do not work out, some of which will generate meaningful losses before they are exited. The question is not whether you will experience these losses. You will. The question is, what happens to your subsequent investment behavior after a significant loss is realized? The losing investor, after taking a substantial loss, often enters into a state of emotional distress that systematically impairs their subsequent decision-making. They feel the need to recover what was lost. They feel an urgency about making back the capital quickly. And this urgency leads them toward riskier, less disciplined behavior than they would normally exhibit. They take larger positions. They enter trades with weaker theses, attracted by the potential for quick gains that might restore their confidence and their portfolio. They hold losing positions longer than they should, because the thought of taking another loss on top of the recent one is emotionally unbearable. In short, they allow the emotional residue of the past loss to distort their decision-making about entirely separate future opportunities. And frequently, this leads to further losses, creating a spiral of compounding mistakes. The winning investor handles the aftermath of a loss very differently. They allow themselves to feel the natural emotional response to a significant financial setback. They do not suppress it or pretend it is not there, but they process it quickly and then make a deliberate, conscious effort to reset their emotional state before engaging with the next investment decision. They treat each new opportunity as a fresh evaluation, entirely independent of what happened in the past. They bring the same analytical rigor, the same adherence to their pre-committed rules, the same emotional neutrality that they would have brought if the recent loss had never happened. This is easier said than done, of course. The emotional weight of a recent loss is real and significant, and it does not disappear simply because you decide it should. But the winning investor has developed specific habits and practices that accelerate the process of emotional reset. They may review the trade that generated the loss and identify specifically what went wrong with the execution, distinguishing between a good decision that produced a bad outcome because of factors outside their control and a genuinely poor decision that violated their own rules. If the loss was the result of following the rules, of having a pre-committed exit that was triggered appropriately, then the correct emotional response is equanimity. The system worked. The loss was limited. Move on. If the loss was the result of violating the rules, of letting a rabbit behavior or a raider impulse override the pre-committed plan, then the appropriate response is honest recognition of the error, a reaffirmation of the rules, and a commitment to follow them more consistently in the future. There is also a broader truth worth stating about the relationship between individual investment decisions and long-term wealth creation. Freeman-Shor makes this point forcefully, and it is one of the most important insights in the entire body of work. Over the course of an investing career, the vast majority of your financial outcome will be determined by a very small number of extraordinary investment situations. There will be perhaps 3, 5, or 10 truly exceptional investments that, if held properly, will generate returns large enough to define your long-term financial trajectory. Everything else, the hundreds of other trades and positions and decisions made over the years, will contribute modestly at the margins. But the extraordinary few will be the ones that genuinely matter. This insight has a profound practical implication, because it means that your primary execution objective is not to be consistently brilliant across every trade. It is to ensure that when one of the truly extraordinary situations arises, you are in a position to hold it well and capture the full magnitude of the opportunity. The connoisseur who holds an exceptional business for 10 years and generates 1,000% return does not need to be right on every other trade they make. They just need to have been present for that one extraordinary situation and to have executed it with the patience and discipline that the connoisseur approach demands. This also means that the greatest execution risk any investor faces is not the risk of being wrong on a specific trade. It is the risk of being right about a truly exceptional opportunity and then failing to hold it long enough to capture the full return. The risk of being a raider when you needed to be a connoisseur, because you can make back the capital lost on a bad trade relatively easily, given time and disciplined execution of future opportunities. But you cannot recover the missed return from a great investment that you sold too early. That opportunity is gone. The compounding period you were present for, but then exited, is a one-time event that does not repeat itself. Let us now look at what all of this means in practical terms for someone managing their own investment portfolio. The principles Freeman-Shor articulates were observed in the context of professional fund management, with institutional capital and professional infrastructure, but they apply with equal force and perhaps even greater ease to individual investors managing their own money. Because individual investors, unlike professional managers, have advantages that are often underappreciated. Individual investors are not subject to the short-term performance pressures that frequently force professional managers to make suboptimal decisions. A professional fund manager whose portfolio is underperforming a benchmark for several quarters may face intense pressure from clients and from their own organization to make visible changes, even when the most rational response is patient holding. The individual investor answers only to themselves, which means they can practice the kind of genuine long-term patience that the connoisseur approach requires without any external pressure to show short-term activity. Individual investors also have the flexibility to hold a genuinely focused portfolio of well-understood positions, rather than a large, diverse collection of positions driven by benchmark considerations or institutional risk management requirements. This flexibility directly enables better execution because, as we have discussed, excellent execution is much harder when you own many positions that you understand only superficially. The individual investor who holds 15 deeply understood positions, each with a specific written thesis and a clear set of pre-committed exit rules, is in a far stronger position to execute well than one who holds 100 positions, driven by a desire to diversify across every available market sector. What does excellent individual investor execution look like in practice? It begins with the pre-trade plan, which we have discussed extensively. Before opening any position, write down the thesis, the exit rules, the criteria for adding if the position falls, and the criteria for holding if it rises. Write it down specifically, in detail, in a form that you can refer back to later. This is the foundational discipline from which everything else follows. Maintain a trade journal. Record every significant decision you make about your portfolio, not just the entry and exit trades, but the decisions you make to hold when you considered selling, the decisions you make to add when you considered standing pat, the decisions you make not to act when the market noise was loudest. Over time, this journal becomes an invaluable record of your behavioral patterns, revealing with clarity whether you are trending toward the winning types or the losing ones, and identifying the specific situations and emotional contexts in which your execution tends to break down. Conduct regular, systematic reviews of your existing positions, not daily price checks, which tend to generate noise-driven reactions rather than analytical assessments. Genuine, analytical reviews at regular intervals, perhaps monthly or quarterly, where you revisit the written thesis for each position and honestly assess whether it is still intact. Is the business developing as you expected? Has any new information emerged that is genuinely relevant to the long-term thesis? Have any of your pre-committed exit criteria been triggered? These reviews, conducted consistently and honestly, are the ongoing management work that ensures excellent execution is not a one-time event, but a sustained discipline. Finally, track your process separately from your outcomes. Record not just whether each trade made or lost money, but whether you followed your pre-committed rules at every key decision point. Did you exit when you said you would? Did you add based on analysis or on emotion? Did you hold your winner as long as the thesis remained intact? Or did you exit prematurely for raider reasons? Over time, This process tracking will tell you far more about the quality of your investing than your financial results alone can reveal. Because in a probabilistic environment like the financial markets, good decisions sometimes produce bad outcomes, and bad decisions sometimes produce good outcomes. Only by tracking the quality of your process can you reliably distinguish between the two. As we draw toward the conclusion of this exploration, let us reflect on the culture of investing that most of us inhabit, because there is something about that culture that actively works against the principles of excellent execution. We live in an era of extraordinary information abundance. Financial media, investment research platforms, social communities of investors, podcasts, newsletters, all of these generate an enormous and continuous flow of content about investment opportunities, market trends, and individual stocks. Much of this content is genuinely valuable, but the collective effect of all of it is to create a culture that is intensely focused on the finding of ideas and almost entirely silent on the management of positions. We celebrate the investor who called a stock correctly. We celebrate the analyst whose price target proved accurate. We admire the fund manager who spotted a trend before anyone else. But we almost never celebrate the investor who, having spotted a trend early, then held their position through 5 years of volatility with perfect discipline, refusing to take quick profits at every opportunity, and eventually captured the full magnitude of the 10-year move. And yet, it is exactly this second skill, the holding, the managing, the patient execution, that actually generates the extraordinary returns that everyone in finance says they want. This cultural bias toward idea generation and away from position management is one of the structural reasons why execution quality is so consistently poor across the investment landscape. Investors spend most of their time and energy searching for the next great idea, attending to the exciting and glamorous part of the process, while the boring, demanding, psychologically difficult work of executing their existing positions well receives a fraction of the attention it deserves. Freeman-Shor's work is, among many other things, a powerful argument for rebalancing this attention, for spending more time on managing what you already own and somewhat less time on the perpetual hunt for new opportunities. There is one final thought that ties all of this together, and it is the most honest and most empowering thought of all. Everything we have discussed, every principle, every rule, every framework, is entirely within your control. You cannot control what the market will do tomorrow. You cannot control whether the company whose stock you own will announce good or bad results next quarter. You cannot control the macroeconomic environment or geopolitical events or the decisions of other investors. But you can control your plan. You can control your rules. You can control whether you set a pre-committed exit level and whether you follow through on it when it is reached. You can control whether you hold your winner with connoisseur patience or sell it with raider haste. You can control whether you add to a losing position based on analysis and conviction, as the hunter does, or whether you freeze and hope, as the rabbit does. This control is not absolute. Human psychology is powerful, and the forces that push us toward the losing types are strong and persistent. But the control is real, and exercising it consistently, building the habits and the systems and the pre-committed rules that keep the emotional mind from overriding the rational one at critical moments, is the most important work any investor can do. Not finding better ideas, not developing more sophisticated analytical frameworks, not accessing better information or better technology. Executing better. Behaving differently in the specific critical moments that determine investment outcomes. That is the work. And that is the art. Every trade you place from this point forward is an opportunity to be a different kind of investor, to approach the position with a written plan rather than a vague intention, to set the exit level before the emotion enters the equation, to evaluate adding based on analysis rather than hope, to hold the winner based on conviction rather than selling it based on anxiety, to be the hunter when the situation calls for it, and the connoisseur when the situation calls for that. To refuse, consciously and deliberately, to be the rabbit, the losing assassin, or the raider. The markets have always rewarded patient, disciplined, self-aware investors. They will continue to do so. The opportunities are real. The businesses that will compound their value over the coming years and decades are out there, many of them already available to any investor willing to do the research and, crucially, the execution work that turns good research into great results. The question, always and ultimately, is not whether the opportunities exist. The question is whether you will capture them when they arise, or whether you will allow the emotional patterns of the rabbit, the assassin, and the raider to take the returns from your hands before they have time to compound into something truly significant. You now understand the difference. You now have the framework. You know what the 5 types look like. You know which behaviors to cultivate and which ones to resist. You know why the pre-committed plan matters more than any gut feeling. You know why process beats outcome as a measure of investment quality. You know why execution, not intelligence, not research, not access to information, is the true differentiator between investors who build real wealth and those who fall short of their potential. What comes next is yours to decide. The market opens every day. The opportunities come and go. The emotions rise and fall. The rabbit in you will want to freeze when a position falls. The raider in you will want to take the quick profit when a position rises. The assassin in you will want to act decisively at precisely the wrong moments. These impulses will not disappear, but they do not have to win. Your plan can win. Your rules can win. Your discipline can win. That is the art of execution. And now, it is yours.